at NYSIF, our mission is guaranteeing workers' compensation and disability insurance to New York State workers. And as our CEO, Gaurav, and our chairman, chairman, Mr. Theobald, mentioned earlier, we are really an impact institution. The impact that we have on these workers is important to us. So when we think about ESG, we talked about labels a little bit earlier. I like to think about it as what are we thinking of from a sustainability perspective, from a real impact perspective. Sometimes we get lost with these acronyms. We're a pretty, we're a state agency. We manage around $20 billion in assets. And so we announced our climate action plan in October last year, which was a first step in thinking through how will we as an institution be more sustainable in this ecosystem. Our goals are to influence this ecosystem, to be a little bit different and to lead in certain ways. And I'll talk a little bit about that. One major piece of this is there is a lot of authenticity that is questioned. Are people actually looking to be sustainable or just talking about it? And from our end, that authenticity is critical to our mission. We want to be an authentic player in this space. We want to be actually having an impact, to be data-driven. That's another critical piece of it, to be data-driven and evidence-based in terms of the impact that we're having. And then two other pieces. It's important for us in our solutions that we propose or in the investments that we make to have an impact on the real economy, not just across the state, but across the US. And then finally, a lot of this transition towards sustainability is questionable. A lot of the times it's not just. There are some winners who may have been the winners in the traditional investing ecosystem anyway. And so thinking through a just transition is an important part of how we're looking to do things. And I'll talk a little bit more about this when we go through opportunities for MWB managers. There are 4 specific actions that we've started taking. The first is we're thinking about how to divest from certain industries, and we've made some headway, especially in the coal space. The second is engaging with both managers and underlying companies. How will we vote our proxies? How will we write letters? How will we influence that ecosystem? Is critical to us. And there have been actually several events that we've staged and spoken at where we've invited other managers and other players in the space to come and debate with us the best ways to become more sustainable. Thirdly, we're looking to integrate ESG or sustainability across our entire portfolio. So while Anika and I are the ESG team now, and we are looking to grow this team, it's not for a specific part of the portfolio. It's across the entire portfolio because fundamentally we believe that these factors are financially material and are in the best interest of our fiduciary duty. And that is critical. So we are integrating it across our portfolio. And to do that, we're training our team, all our investment managers, to integrate these factors. In fact, we're running through right now an 8-week series of external speakers, experts, faculty members that are training our teams around some of these factors and how it is financial material across all asset classes. The final point I'll make, or the fourth action that we're taking, is looking at, and this is something we're considering, we haven't announced this yet, but a sleeve of our portfolio that will actively look to make sustainable investments. And this will be across the environment, social, and governance piece. So we're not, whilst climate is our main thrust, the social impact and other aspects of ESG are critical to us. So, we're still thinking about what that size would be, but it would be across all asset classes that would more aggressively move us to our sustainability goals.
So our first question is, what are some of the broad trends you've been seeing in Roselyn emerging markets and ESG investing for you, Rajith? So, Rajith, I'll start with you this time. We'll switch it up.
Okay, thank you. So I guess I'll start off by first thinking about how do we define ESG and sustainability, and therein lies an issue. Everybody here, if we went around, will have a different view of what we mean by ESG, and I heard questions earlier about focusing on the E, the S, or the G. And I would say this is basically the whole space has come after a focus on responsible investing that started off very intentionally in the 70s. It actually started off, when we think about the responsible investing industry, it started off through the anti-apartheid efforts of certain asset managers, mainly in Europe and the US. And so there's a big South Africa linkage, actually, to the entire responsible investing space globally, which is interesting. And so, when we think about the space, it's an entire continuum that could be from how do you maximize impact more actively to how do you minimize risk by controlling, some of the efforts around climate, social, or governance. And the ESG space primarily was on that risk mitigation space. That's how we, traditionally used to think about it. But more and more, ESG has become the umbrella that we think about when we think about how can we have more impact on the ecosystem and have more sustainable enterprises. So I don't have a clear definition for you. What I would urge you to think about is a continuum of how can we be more impactful and sustainable, looking to both at opportunities as well as opportunities to maximize your risk-adjusted returns, but also to be more resilient and to minimize your risk. So whilst the estimates of the space, just based on definitions, have reduced, the growth of the space is still very resilient. And even the best estimates still expect this share of sustainable investments to grow up to 20% of assets under management by 2025. So in terms of what that might be, whatever 20% of $150 trillion is going to be, it's a pretty big opportunity, I think, for all managers. The other trend that we see in terms of growth is sustainable investing is being perceived more as not a niche, but part of investing more generally. And certainly at NYSIF, that's how we think about it. We don't think about this team as making investment decisions that are more sustainable. We think about it as how will all of us be incorporating these ESG factors or these sustainability factors into all investments. So it becomes part, the best data shows that this is going to become part of investing. It's going to be how you consider, for example, your WACC or your cost of capital. Just as analysts will consider those factors, they'll start considering what are the sustainability factors. There's been an increased use of ESG rankings and ratings, a growth in demand for proxy voting and shareholder engagement, increasing demand for ESG data. It will be there in 20 years, 30 years, 50 years. We might just call it investing. And then I talked a little bit about the need for authenticity in the space, and that's been a trend that's been growing. There's been more calls for authenticity. That's something that at NYSIF for us is a huge pillar of what we're looking to do.
And Roselyn, if you want to share the trends that you're seeing in emerging markets?
Definitely. Carbon emissions, eliminating carbon emissions is the big trend we're seeing in Africa. Now, Africa is not the highest emissions of carbon in the world, but there's a lot of emphasis being placed, especially on South Africa, to decommission their coal mines. So what we're seeing in emerging markets, and I believe world organizations are starting what I would call small, because places like Indonesia and Vietnam have more carbon emissions than in other parts, right? I mean, the US is like top there with China in terms of pollution. But there are solutions being developed, and these solutions need support. They need funding, they need understanding, they need capacity building around them. And what can we do to support emerging markets, particularly to decommission not necessarily the coal mine, but to find a way to capture that emission so that they can have power. At the same time, there's this just energy transition, which I talk about, trying to transition from coal to renewable energies. So there's a lot of investments going into renewables, whether it's solar or wind or natural gas. There are opportunities out there, guys. What I'm trying to say for our emerging managers in the room, look at the unlisted markets. Look at the opportunities in the emerging markets. There's a lot of funding on the table that is not being claimed. We have to find a way to get to it. The G7 countries have allocated another large sum of money to climate change and decarbonizing the environment. So if we go beyond our borders and we look beyond our immediate city and public pension funds, there are other sources and opportunities out there for emerging managers. And if you're looking in that area, we can crowd in our pension funds to come in and join us.
And so we could move on to our second question, which is, what do you see as the top challenges and the top opportunities in emerging markets and ESG specifically? We'll start with you again, Rajith.
Okay. So I'll talk a little bit about opportunities. I think based from what I said earlier, this is a large space and it's growing really quick. So assume it's between 20 to 30 trillion dollars in terms of assets under management that are there in this space in by 2025. Someone is going to take advantage of this. Now the question is it going to be traditional finance, which has traditionally not been very inclusive? Or are MWBE, our minorities, going to be more involved in this transition? And so I think that's the big question for all of us to think about. I think there are opportunities for minorities to be much more involved in this space, and our CIO, Greg, spoke to this. And I'll make 2 points. The first is diversity is an important component of sustainability. And the second point is that diverse managers may have a competitive advantage here. And both of these are backed up by some data. So let me go into this in a bit of detail. So already diversity is seen as financially material. There are a lot of studies that talk about how there's a correlation between diversity and inclusion across gender and ethnic minorities to stronger performance, to better decision making. I'm sure we see that in our teams anyway. More diversity brings to a diversity in thought, better decision making, and that leads to greater resilience. The fund that I work with at the Wharton School is focused on the social determinants of health, which are really the environmental factors that mean an African American living in one zip code has a lifespan that is 20 years lower than an Asian or a white male in a different zip code. And that zip code might just be a bridge apart. The second is the solutions that we propose. So let's talk about divesting in fossil fuel. Something like that is probably a great thing for the environment and long-term great for the world. But in the short term, will have negative impacts, and primarily on people of color, women, and children. Even in the US itself, divesting from coal will have a major impact on the Midwest, and it's mainly lower income populations. And the same thing applies in sub-Saharan Africa if we're looking to divest from certain fossil fuels across the continent. So minorities are, again, invested in this, and this lived experience may allow minorities and MWBE groups to actually have an advantage in thinking about what are the best solutions, what are the best structures that have long-term sustainability. Some other examples are there's a lack of innovation in this space as a result. We see a lot in equities, for example. We see very little in public debt. We see almost nothing in structured products. And so, we think there are opportunities, especially for MWBE managers. There's so many open spaces here. I would think about it like if you think about an innovation curve, which is typically like an S. We're very, very early in the innovation curve of what sustainable investing is. And so potentially the new leaders in finance and investing could be some of you here around the table because this space still needs to be defined.
In South Africa, we try to focus on debt, right? Because it's an easy way for public funds to invest in an unlisted market and into infrastructure and in renewable energies that can actually promote economic growth. So, look the other way. Find those opportunities because there are funding in those areas. And if there's not, let's make an argument for it. So there are opportunities there. What I would appeal to our state pension funds and our state insurance pension fund is when you look in your asset allocation, maybe broaden it a little bit, maybe consider some of these other sectors, and maybe what we saw was just a broad view. There could be more little pockets underneath that, But I would say take a look at infrastructure development and take a look at the international markets and emerging markets where some of the managers can participate. And there are organizations out there that we can introduce you to that can help to bring teams together to work on these opportunities and to do it in a manner that's safe, that will provide the returns that you expect, and at the same time creating real impact, not greenwashing, but real impact to economies. We can do it here, and we can do it abroad as well.
Great, so we'll move on to our next question, and we kind of have already been talking about this in the past two questions, but for this audience especially, if you could both elaborate on how emerging managers can become more involved and best position themselves to take advantage of the opportunities that we're discussing, and how do emerging managers set themselves apart from larger institutions? Rajith, I'll start with you again.
Oh, me again? Okay. So I think I talked a little bit about how emerging managers or MWBE managers set themselves apart. But I would say a couple of things. The first is there's an opportunity to really lean into this space because nobody's got the space figured out on sustainable investing. As much as they say we know what works best, it's still very, very early in the life cycle. Mm-hmm. And so the opportunity to really lean in, and by that I mean participate in the research around this space, understand different fund theses, understand greenwashing, be in those debates around the space. Have your say because it's unique and it needs to be heard. One of the challenges that I see going around conferences that discuss sustainable investing or ESG is there are not enough minorities in the room that are in panels or even in the audience discussing this. And that has to change. The right people in the room, minorities, MWE firms have to be part of the discussion around solutions. Mm-hmm. But I would say lean in because your voice is an important voice. Mm-hmm. The second piece is innovation. For the same reason, in terms of early in the life cycle, tons of opportunity to innovate. And so there's not enough product out there. There's certainly not enough authentic product out there. So as an asset owner like us, we're very, very stringent. You can ask Anika about this in terms of how we analyze each investment. And we really write off a lot of investments that are not authentic about either climate change or the social impacts that they promise. So the need for authenticity is huge, and I think the innovation that can happen in that space across asset classes is really incredible. And then finally, partnerships. So one of the things that we think could happen more, certainly at NYSIF, we're looking to do this to create more partnerships. But partnerships and at NYSIF we think about it around partnerships around asset owners, with advocacy groups. But for MWBE managers, it will be interesting to see what if you all partnered together to have a much larger voice around a specific issue, for example, workers' rights or climate change. What could that look like? Partnerships with other institutions that have similar goals, like foundations. The assets under management and foundations that are clearly mission-oriented are tremendous. And so asset owner foundation partnerships, or even corporations, all of whom tout the label of sustainability or ESG, that could also really be interesting.
That's a very interesting segue about partnerships, because most of the work we do in Africa, we must have partners. There's no way a small firm like my firm can go into Africa and accomplish so many big objectives. We have a lot of partners that we work with, different partners. We work with the international partners, we work with local partners, we work with US-based partners. But if there is a plan and there's opportunities, we can circle back to the funds, right, and ask them for funding for it. I think that's where I see the opportunity. Find a way to partner and even ask the funds, who should we partner with? Who do you see in your universe that's approached you that you think we can partner with to invest in opportunities in Africa or here in the US? There's a lot of opportunities, but it's just the packaging and the solution for it. What their needs are versus how you can deliver on those needs.
How can investors amplify our impact on the real economy in both market opportunities? So Roz, I'll start with you. Kind of speed round.
Yeah, no. I mean, impact is really looking at it from your standpoint. Would you invest in an opportunity, and why would you invest in that opportunity? Would you invest in student housing? There's tremendous impact in student housing. Would you invest in a bond deal that provides mortgages for people in West Africa? That's a huge impact. Would you invest in an energy project that would provide clean energy and contribute to that, rather than decommission these coal mines in West Virginia or in South Africa or Indonesia? Let's find a way to clean them out, to put more innovative working process or machinery or whatever they need to decarbonize and get cleaner outcomes from it.
So, the impact on the real economy is critical for us at NYSIF. And so what that means for us is, are we creating jobs? Are we helping small businesses? And then thinking deeper about that impact. Who exactly is being impacted? Which population groups? Are they underserved? How much is that impact? How sustainable or how long-term could that impact be? I would say factors like that are critical to us. Thinking about the multiplier effects of, for example, funding wind farms. What are the multiplier effects on the local economy, on creating jobs, on cities around there that will happen over time.
Mac McReynolds with Multi-Bank Securities. Been one of the broker dealers for a while with NYSIF. You spoke about asset managers investing in ESG bonds. Can you buy ESG bonds directly from broker dealers?
I think that's a good question. So, first is what is an ESG bond? So I would, green bonds are probably the most common name for something that is more sustainable. Green bonds, as you probably may have seen, there's a lot of redefinition to that term recently, and actually, a lot of reduction in funding that goes there. But more and more, they are sustainability-linked loans, green bonds, other sustainable-linked debt products that are coming onto the market that we think will be available to buy through broker dealers.
I'm in year 32 of being in the investment business. And throughout my entire career, I've always been taught to focus on generating returns and generating the best risk-adjusted returns. And I sat there and I listened thoughtfully to the presentation, but I think we were somewhere around minute 12 before someone mentioned return, and throughout the whole presentation, return was always mentioned twice. Now, having been taught throughout my career to focus on return, as a Black-owned firm, I've been taught to understand that my returns have to be even better because I have other obstacles that I have to overcome. If, as an African-American owned and led firm, I'm going to focus on an area that to some extent is unproven ground or difficult to quantify, and in doing that, give up my preoccupation with return, I guess the question I have is, are you now going to evaluate me based on those softer factors, or are you still going to want me to generate return in addition to kind of having this impact on sustainability, on climate, and all of these sort of other factors, that you talked about?
I think what you're asking is the same side of the same coin. I don't think there's a distinction between performance and due diligence, right? I think they work hand in hand, right? The climate change or ESG provisions are embedded in your due diligence process. And if you are using those factors for your due diligence, there's no question, giving market conditions, interest rates, and everything else going on, but there's no question your performance will be good. So I think you can still do good and have strong performance.
I think if we didn't mention return, it was implied through talking about how these factors need to be financially material. The research is mixed in terms of financial returns around sustainable investing. But if you look at the meta studies on this, so the studies of the studies, they show that there is no downside, so there's no negative returns that have been shown over something like 130 studies to sustainable investing. In fact, an independent study that the Wharton School did said that there was, or showed there was anywhere between 10 to 50 basis points benefit through sustainable investing over the last 15 years than prior. But the end point is these factors are financially material. We have a fiduciary duty, so we will only look at financial materiality. How do these factors influence your cost of capital, your cash flows? And there are instances where, for example, if we're moving to renewables, one thing that people don't think about is how much increased capex that is on the balance sheets of companies, which might result in short-term negative cash flows. But we look at it over the longer term, and we're able to project the upside in that as costs decrease over time. So my point here is, and actually one of the more innovative things that we've done recently is looking at how do you quantify some of these negative externalities. So the greenhouse gases that we're putting out, these companies get sued over time. Look at ExxonMobil. So what is the reputational damage? What are the legal costs with that? And how can you quantify that? Legal costs you can quantify easily, but there's more and more data coming out on how to quantify reputational damage to these companies. And these are across over the last few years. If you look at the motor vehicle industry, fossil fuels, as I mentioned. And so once you start doing that, the way we value will change. And that's why I think this is super interesting. While you looked at those financial factors, the WACs and all of that to do valuation, the students that we're teaching at probably what is the top finance school in the world, we're teaching them how to incorporate these externalities that come from pollution, from racial inequity, from from relocating people because you're going to put a solar farm there. We're quantifying that in valuation models, and I think that's the talent pool that will come out into the space over the next 10 years will be doing that more and more.